So we've got a very interesting discussion today regarding private insurance. Is it market failure or business as usual? My name is Michael Creighton. I represent WTW, previously known as Willis Towers Watson, and we are a credit and political risk non-payment insurance specialist. We're a broker working on behalf of financial institutions, corporates, and export credit agencies, sourcing credit and political risk non-payment insurance cover in the private insurance market. My three panelists who will be joining me shortly is Ollie Wright, who represents BPL, and he is also, and BPL also, like ourselves, a credit and political risk insurance broker. Then we'll have Genevieve on our panel. Genevieve represents a credit and political risk non-payment insurance company referred to as Africa Specialty Risks, or ASR, which is a new credit and political risk insurance player in the market, focused specifically on Africa and credit and political risks in Africa. My third panel member is Sekete. Sekete is head of the export credit finance division at Nedbank, specializing in funding transactions on the back of private and public credit insurance and political risk insurance. So we have a good mix of panelists representing the non-private insurance sector, a bank that's a buyer of the product, a broker that sources the product for customers and interacts with insurance companies, and then Genevieve, representing the insurance sector. So just to give some context to the discussion, late 2021, the OECD ECA committee made an announcement to increase the ECA coverage from 85% to 95%. It's been put in place for a trial period of 12 months. Soon after this decision had been made, GTR interviewed a number of industry players and presented late last year a very interesting journal article addressing the topic. As part of the article, they quoted an OECD ECA representative who made some quite scathing comments about the private insurance sector and as to how come the ECAs had reached this decision. So some of the comments that they made, that under normal circumstances, buyers would have the possibility to finance the down payment with longer repayment terms, as financing banks could usually be able to source cover from the private insurance market. But the COVID-19 crisis has thrown the market into disarray, the OECD says, with the private sector seemingly very reluctant or even unwilling to provide this cover for developing countries. Without such cover, banks are not ready to finance that portion of a project in a country, which are most in countries which are most in need of such projects. We are therefore in a situation of clear market failure that has to be addressed urgently. So that's quite a strong statement coming from the public sector ECAs. And so this is the topic that we're going to address today. The topic's not specifically aimed at debating the ECA decision. It's more about addressing the view that has the private sector industry over the pandemic, has it let down the customers, and can it be considered failure? And my three panelists are very well equipped to help us respond to this issue. Sorry, Sekete, you've just arrived, but we're going to throw you in on the hot spot. Sekete, as a representative of an African-focused bank that does both ECA-backed transactions and transactions backed by the private insurance sector, what are your views with regards to this statement? Would you feel it's reflective of the reality, or do you think it's not quite reflective of reality?
Yeah. Thanks, Michael. Maybe let me just start by introducing myself. Sekete Mokgehle. I head up the export credit finance business at Nedbank CIB. Our role is to arrange risk-mitigated debt solutions for the rest of Nedbank CIB across various sectors, including lending money to sovereigns. To your question, was it, should we be describing it as a market failure? My view is that no. I think it's an unfortunate choice of a phrase, because clearly there wasn't a market failure from our perspective. A couple of points. Perhaps it was a challenging environment. Perhaps it was a frustrating environment to some of us when we didn't necessarily get what we were looking for in terms of capacity. But in no terms was it ever a market failure. And I'll give a couple of examples if you allow me. We continue to see business taking place during the past 18 months. In fact, wasn't it the African continent that, from an export credit finance point of view, we've seen record levels of ECA finance happen, multilateral finance happen. And each of that was backed by down payment and tranches that were insurance-backed, which means there was insurance activity. I mean, I could go further to give you some specific examples just to bring home the point. And from a Nedbank point of view, we continue to write deals. I mean, we did, beginning of last year, we closed a intersection in Angola where we went into the insurance market and we financed the intersection at a huge cost, all of it insurance-backed. Some of you would have seen that we participated in a deal that happened in Cote d'Ivoire with NMS, giving some free time to NMS. With NMS, where we participated in that deal, we got it insurance-backed. You saw us at the beginning of this year with two other African institutions joining an international global bank, doing the book running and MLA and holding a chunk of the lending into Ministry of Finance Tanzania. That was new capacity we got. In fact, towards last year, beginning of the year, we increased on our Tanzania SGR, where initially we struggled getting the right capacity for the amount we looked for. We continued with our brokers scratching the surface. In fact, we ended up being oversubscribed, getting a bit more than what we were looking for. So there's no, I wouldn't say it was a market failure. Perhaps one of the things that I must put on the table is that, and I sympathize to an extent with the insurance industry. I mean, there were a couple of factors, Michael, that permeated the industry. Some of the factors included the fact that with COVID coming through, we saw an elevated risk environment. We saw possibility, I mean, analysts were saying there's expectations of claims coming through to hit the insurance industry. We saw geopolitical and economic risks rising. Some rating data pointed out to the fact that there was an emergence of defaults in the horizon. I mean, what do you do as an insurance industry in that environment? You're going to be cautious when you underwrite. You probably might start pricing the risk of that uncertainty. And it is all of these things that we've seen in the market. But as I said, deals were done, and in no way was there a total failure. To conclude, as I said, my view is that there were challenges. There was ability to continue doing business. Institutions like ourselves continue to exercise on our mandates, and market failure is a wrong phrase to use.
Thank you, Sekete. Ollie, as a credit and political risk insurance broker, what has your experience been over the last sort of 18 months, 2 years?
Well, I think you're am I on? Yeah, oh yeah. I think we're going to have a very collegiate panel here, because I think we're all going to be singing from the same hymn sheet. I mean, I thought the premise of the agenda was slightly provocative in terms of market failure, and what we see on the ground certainly doesn't look like market failure in terms of the deals in Africa. What I think would be a fair point to say is when the pandemic first hit, sort of March 2020, there was definitely a bit of a gumming up in the insurance market in terms of just inquiries coming through from clients, but also the underwriters themselves were basically just taking stock of the situation and saying, okay, what does this actually mean in terms of potential losses? So things did slow down for maybe 2 or 3 months. But after that, we found that inquiry levels and bind rates and so forth sort of started going back up to expected levels, comparable to the previous year. I mean, from our own statistics, we probably bound between January 2021 and the current day, we found about $2.8 billion worth of new policies covering risks in Africa. Where there has been issues, it's been around capacity rather than appetite. There's 1 or 2 cases where particular countries, for example, Zambia, where the sovereign default, underwriters were less willing to take risk there or were completely off risk. But most of the situations we found where clients were not getting the response they wanted from the private market was where they were all trying to chase sort of capacity in some of the constrained countries. So places like the Ivory Coast and Ghana and Kenya, Angola and Nigeria are all areas where we see demand for capacity outstrip supply. So that's where I think there might have been perceived shortfalls in capacity. But I'm not entirely sure myself where the OECD sort of got how far they spread the net in terms of looking for consensus on people coming back with the conclusion that there was some sort of market failure. It was a market slowdown, maybe, at the very least, in our view. The other point I'd make is on the down payment changing from a 15% to a 5%. Has also caused some issues from the insurer's perspective. Going from a 15% piece of the pie to a 5% is less attractive, so there's less premium involved in it. And also from some of the exporters we've spoken to, they actually quite like getting a 15% down payment up front and not having to wait until certain milestones have been met under the contract before they get the 95% finance. So it's not, from our perspective, not being universally accepted with a round of applause. Should I put it that way?
Thanks. Genevieve, it's ASR and yourselves, it's an interesting situation because you're a new insurance player, Africa-focused, and basically have started up in the middle of the pandemic. Do you think that startup was facilitated by this, let's say, lack of capacity from the more traditional players? And how's your entrance into the market been perceived?
Thank you, Michael. I wouldn't say that it was the lack of capacity in the market was the reason for sort of ASR's entrance. It was more Africa generally has a constraint when it comes to insurance capacity, full stop. It's not new. There's been various schemes and companies trying to plug that gap. But in terms of the insurance appetite, as Ollie and Sekete have alluded to previously, you had COVID. At the same time, you had banks and other financial institutions running for the hills when COVID hit, and the potential or expected implications on Africa versus how it actually resulted is a different discussion. And ASR was formed to support the market. The capacity is there. As Ollie has said, there are some countries which are difficult, and there are some countries where everybody wants cover. So you've got the Angolas, you've got the Nigeria, you've got the Cote d'Ivoires, and those are typically the ones where banks such as yourselves might face some constraints. It doesn't mean that there's a failure or there is a lack of appetite. As ASR, when we first started, we came into the market in August of 2020, and then subsequently we started binding in February. And when we came in, we were welcomed with open arms because it's fresh capacity. And the market was very pleased that in this current environment, with all the strange happenings of COVID, are we going to get a tsunami of claims? Are insurers going to shut shop? The trade finance gap in Africa getting bigger? And we are here. providing additional capacity within Africa and only Africa. So we've been very well received. We've been inundated with inquiries, if I can say that.
Michael, maybe before we get off the subject, just for me to weigh in on the whole issue of the OECD's 15 to 5% down payment, and just my take as a commercial bank, I still think it is, and I know this is a controversial subject, and I know it will be given airtime later, but my few thoughts on it is that it's actually a very good thing to do. It is assisting African or emerging markets, Africa in particular, with the liquidity support, particularly in some jurisdictions that, as Genevieve just said, some commercial banks may not be keen to go into those jurisdictions. Maybe let me just mention an example. I mean, we see in Tanzania the rollout of the SGR and the excitement amongst commercial banks and everyone else going in. Burundi wants to put their own SGR line into Isaka on the eastern side of Tanzania. Are we going to see a flurry of banks heading that direction, helping Burundi? I don't know. My guess is that there are certain jurisdictions that the commercial banks will always have limitation in terms of ability to assist. And this, to me, was a good step. The pie is bigger. Africa's infrastructure gap is wider. And we will all get a seat on the table if we go in and assist the sovereigns in terms of trying to bring to market the capital expenditures and projects that they need for the economic growth.
I think those are all very valid points. I think and it was mentioned in the previous panel, the importance of infrastructure and that Africa needs its infrastructure if they're going to, if it wants to tap into regional trade. So I think you're right. I think there is value. If ECAs are prepared to cover bigger transactions and more of that transaction, that can only be good for the continent. And there's plenty of transactions and plenty of financing that's required, that there's space for both public and private sector insurance players. But maybe the issue, and I think it's coming through here, is probably the reason used to justify the decision is not quite a correct reason. But the result has positive implications for the continent. Maybe moving on a little bit, I think in a capacity-constrained environment, certainly our experience, there seems to be a degree of selectivity from insurers. So capacity is available for certain transactions and not always for other transactions. Ollie, in your experience, what are your views on that? And is it easier to get insurance cover for certain structures and transactions versus others? And what are those? What insurers look out for?
I mean, I think that's a fair point. I mean, I think particularly in a capacity-constrained environment, insurers will prioritize certain deals over others. And I mean, an obvious example is the ECAs and the multilaterals and others in that space that buy reinsurance from the private market, where they are heading up a transaction or fronting a transaction. The underwriters in the private market take comfort from either preferred creditor status or a perceived halo effect, and will follow those multinationals into a certain transaction, albeit that they will be receiving probably less premium because the reinsurance will pay less than as if they were insuring the bank on a direct basis. So there's a kind of opportunity cost for them to weigh up there. In terms of kind of other structures, obviously transactions that have got some form of collateral are going to be preferred over ones which are unsecured. And also, I guess, transactions which have an economic and social benefit are going to be perceived more favorably. So particularly if you have a project that provides some kind of liquidity, there's not a strain on the government's coffers. So maybe a concession, a toll concession or a toll road or something like that, where fees are generated and that can be then used as a form of liquidity to repay the debt, will perhaps be perceived more favorably. And also, obviously, the underwriters will be looking at some of the projects that promote more social mobility and social benefits. So that, I think those are the kind of those are the key, as far as we can see, there's kind of differentiators between what underwriters would look for to provide additional comfort versus those which might be paying more in terms of premium, but perhaps slightly further down the credit quality curve.
Thanks. Genevieve, as an underwriter, what are the certain things that you look for when you're underwriting a risk? I'm thinking of the project, the client that's brought the inquiry. What's important to you?
Ollie's already sort of just picked up on a number of the things that any underwriter in our industry will look for in a transaction. The sort of insured that we are working with, the counterparty, the project in question, what's the relevance of the project in the country. If it's not a project and we're talking about supplies, where are the supplies going to? What is the need of that country for those goods? I've been hearing this morning the connection between Russia, Ukraine, and the wheat and the grains that go into Africa. So if you're looking at a market, say Angola, that's critical because of the consumption, and certain parts of Francophone West Africa as well. It is critical. So we look at those are some of the elements. But I think one thing we have to be quite careful is, especially in our market, and this was one of the reasons why ASR came into being, is whilst it's safer to sit behind the likes of a multilateral or a DFI, and I'm not saying that we don't like those transactions, we also need to remember that Africa needs more support outside of the other transactions that take place outside of the DFIs and multilaterals. So some of the local banking transactions, some of the LC confirmations that take place within the country, some of the import facilities that are given out to ordinary companies on the ground, the support of a working capital facility, once again, given to a local company on the ground to support. So sometimes, my previous underwriting role where it's good to be in that position where you can sit behind a multilateral. Remember that the needs of the continent, of the companies in the continent, relies on the ordinary corporate supplying goods and services, the local banks supplying these facilities. So sitting behind them is quite key.
Thanks. Sekete, as an experienced and long-time buyer of the product in the sector, how do you present transactions? How do you go about trying to increase your likelihood of finding capacity?
Thanks, Michael. Maybe a couple of factors that we're employing as our way of approaching the market at Nedbank. One, which I actually found very beneficial, is that we use one broker for all our insurance needs. We think that gives us the ability to consistently present our case in one manner instead of a fragmented way of coming through different angles. But Michael, the key thing for me is track record. You just mentioned it. We're in the fortunate state that we've had this business for a long time. We built a portfolio. We've engaged various insurances. I mean, on the Lloyd's, for example, we probably have onboarded over 90% of the syndicates that are offering CPRI. We have a whole raft of private market insurers. So it is those key relationships that we continue to demonstrate to them, our track record and our ability to do the right things. The other point is we opened last year a London office where my team is represented in London. We think it's the right way to be closer to the key players, the industry stakeholders, to be in their face all the time, to demonstrate to them our methodology in where we're going, why we're going, where we want to go to, and that continues to gives us some brownie points. The other, as Nedbank, most of you may know, we may not have the footprint that some of our competitors have on the African continent. But certainly we have coverage areas in West Africa, through in Ghana, in East Africa, in Nairobi, and of course in the south we've got rep offices in Angola. That to me works well because we continue to be able to demonstrate to the insurer that we closer to the action and we are able to give the relevant information. But I would end on this one, which is very key. Our deal filtering goes through a rigorous process to make sure that we're not going to get an inquiry and pass it to our insurer just because we want to test the market. No. The deal must meet with our risk appetite first, because we're not necessarily going into the insurance market, for example, to go and distribute risk as some would do. We go into the risk market to go get a better capital relief and therefore ability to give our clients better pricing, because we obviously data substitute and look through to the better rated insurer rather than the borrower. And I think from that point of view, that is something that insurers wants to understand where our risk appetite is at. And lastly, we would probably say no to a sovereign that says, oh, we want to build a new parliamentary precinct or campus. We probably say no to that deal. As much as that sovereign might look for it, but would we go to Tanzania and participate in the SGR? Yes, because we think those are productive assets in future, enable the economy of that sovereign to get better revenue pools for their tax obligations in terms of servicing their country.
And I think, sorry, Michael, if you allow me to add to what Sekete has just said, it's the point that he's just made, that as an underwriter, when you're looking at a transaction and deciding, do I choose between this or that, what makes the difference and how do you choose? It's the points that he's just made, i.e. their reasoning, their logic, their rationale, why they want to do it, their analysis, their assessment. It makes it a lot easier for an underwriter if somebody presents you with a transaction which they have thought through, implications, not just I'm protecting my balance sheet and that's it, or I need insurance because, my governance requires me to. Especially when it comes to Africa. So when we receive transactions from insureds who have, thought through the reason why they want the insurance, how they want to use it, and most importantly, the fact that they want to partner with us, that makes all the difference in whether we choose, A, insured or B, insured.
It's a partnering model.
Precisely,
Genevieve
yeah.
is right on it. In fact, the one thing I would add is that not only do we do this rigorous due diligence, we go and share it with our insurer to demonstrate the outcome and why we've made the decision to demonstrate to them that the risk we're taking is one that has been well thought through. But it is a partnership model.
So, I was just going to add to that, in terms of the business relationship and the partnership at the front end, it's also key when things go wrong that the collaborative relationship between the client and the insurer in terms of workouts, restructurings, behaviour during, difficult situations is also as strong as at the front end. Exactly. And underwriters particularly value the relationships where a successful restructuring, a successful workout has come through a strong collaboration.
Yeah. And we're not just talking about banks, we're talking about ordinary suppliers and their relationship with their customers as well. We're talking about, suppliers who have, years of experience, or maybe not years, but they have that strong link with their customers, so that in the event that there is a loss, and let's be honest, there will be a loss at some point in a lifetime, that when we've paid a claim, and we are looking at routes to recovery, we can look at the insured to help us if we're not familiar, whether it's the country or whether it's the customer, that they can assist. So it's critical. The relationship with the insured and the insurer is very, very critical.
We've got a question that's come in from the audience. So if you have questions, please feel free to put them through, and then they get sent up here. So this sounds like somebody that's had maybe a slightly negative experience from the insurance sector during the pandemic. The credit insurance market's reaction to the pandemic was to reduce cover across the board. this is a contradiction to the market where facility needs increased due to specifically inflation, especially evident in the logistics industry. How do we correct this and ensure the next pandemic does not replicate this reaction? Maybe Genevieve, as an insurer yourself, what is your views, of insurers reducing cover at a time when the market often most needs it?
Yeah. I don't think it's a reduction of cover, more a constraint in the cover. So in our market, in what we call the single risk market, so we have different levels. We have the whole turnover market, the single risk market. The single risk market is non-cancelable. You have your policy. Only if you do not pay your premium is your policy cancelable. The whole turnover market is slightly different, whereby your limits can be cancelled on a sort of more of a short-term basis. So during COVID, everybody panicked. Initially, when COVID started, everybody panicked. The banks panicked, the underwriters panicked, we panicked at home, we all panicked. So naturally, as human beings, we all sort of want to stop and consolidate our positions. And a lot of underwriters did do that. Some underwriters, did say, we will just stop writing trade credit for now and just see what's going to happen. Others just said, no new business, but we'll continue with what we have. And others continued writing new business. So there were different responses, but there wasn't a complete withdrawal. And I think this is something that we need to get across. And certainly from our experience, coming in August 2020 and looking to write business, the market didn't just suddenly contract and say, no more trade credit political risk insurance. It was more of being more cautious. So for example, if I'm presented with a supply, a transaction supplying grains, I want to understand where it's going from, what countries it's going through, what are the potential impacts. Because if it's going to go from, say, Ghana to Benin, and it has to go through Togo, and Togo has closed their borders, when you get there, you cannot deliver your goods. And if you cannot deliver your goods, you're not meeting your contractual obligations. Therefore, a claim could be triggered. So more scrutiny was required on the underwriter's part to understand the transactions and the potential impact of COVID. And as a result of that, there was the workload. And so, we did sort of step back. I say we as an industry, step back just to consolidate our position. And as it's materialized that, the claims are not where we were expecting them to be, hopefully it won't get there, are not where we were expecting them to be, we have come back into the market to look at transactions.
Ollie, we've heard about sort of Nedbank talk about their track record, which helps them get cover. We've spoken about well-structured transactions and some of the large revenue-generating transactions. But in reality, and especially maybe if we're talking about smaller African regional banks that maybe haven't had the chance to have that track record, but might be interested in coming to the credit and political risk market for the first time, and may not have clients that are always going in for the big transactions. Is there a chance and is there scope for new entrants and smaller, the non-sort of sexy transactions?
Yeah, I think there is. I mean, there's you've got the kind of the big blue, the big ticket deals, which everyone hears about, and every bank is trying to win the mandate on those, and they're all well publicised and a lot of DFI involvement around those. But there are plenty of smaller transactions which sort of go beneath the radar screen, which are more bite-sized transactions, which are perfectly well structured in their own right. There may well be just as strong relations between the bank and the borrower, but on a sort of less well-known countries or less well-known names, and the underwriters will look at that type of information. But it's also fair to say that some of these smaller deals with less well-known names will be paying higher margins and therefore higher premium rates. And so if you're an underwriter, you want to sort of balance your book between having some nice, well-structured transactions with DFI, ECA type involvement, and maybe balance that off with a smaller portion of perhaps higher paying transactions. But the underwriters will look at each bank that comes as a client and look at their kind of credentials, and if it's a new entrant, what their processes are in place in terms of due diligence and the credit committee approval process, and get comfortable with that before willingly following a client into a particular transaction without doing their own due diligence themselves. So it's a roundabout answer to your question is yes. In theory, there's definitely capacity available. But if they're going to come in with something like another deal in Ivory Coast, then we might have a slightly longer conversation.
Maybe just as a very quick comment before I'm sure that a lot of in the audience, maybe not throw this out to you, Ollie, the Ukraine-Russia situation, is that going to have some impact on the credit and political risk sector? What are your initial thoughts? I know it's early days, but what are your initial thoughts? And is it likely to have an impact?
Yeah, I mean, for sure. I mean, it seems slightly perverse that we're sitting here talking about sort of, everything being, hopefully going the right direction in Africa, whereas everything's going, potentially very wrong in Europe. And, but, I think people have talked around the potential shortage of wheat coming into Africa as something that's going to have a very real effect here. But in terms of the insurance market, there is a fair amount of capacity that's tied up on existing deals. I mean, the insurers don't publish their data. There's not like a league table of like with a loan book or something like that with all the different banks, with their kind of numbers. But based on our own experience and having talked to some people, we think there's probably, on the kind of non-payment side of things, there's probably about 2.5 billion of exposure from BPL clients on Russia and Ukraine at the moment, and the market as a whole, it's maybe to the 3 billion to Ukraine and 6 billion at the higher end to Russia just on non-payment. We know that standstill agreements have already been signed on Ministry of Finance guarantee deals, and then it's on the kind of non-payment side of things, on the kind of more traditional PRI, companies that have got assets and physical infrastructure in place in Ukraine. There are losses happening as we speak, and we're not quite sure where that's going to end up. But the insurance market is cyclical, and you get big events happening every typically 6 or 7 years that cause big losses. And I think what's going on in Russia and Ukraine, unfortunately, is going to be one of those for the private market insurance. So yeah.
I think, yeah, that's our views. The numbers are sort of similar. Sort of somewhere between at least 2 billion on Ukraine and at least 4 billion in Russia. So it's certainly going to have an impact on the market. But the market's shown a robustness. It's handled the global financial crisis and rebounded. In fact, capacity increased significantly after that. We've come through the pandemic largely unscathed. So, as we say, it's a cyclical industry, but the credit and political risk market has performed. Over the last 12 years, all the brokers share information. Our figures are that in excess of $3.5 billion of claims have been paid by the market. It's at about 98% hit rate of claims being paid, so a very small number of claims not paid, and those claims were very specifically due to negligence by the insured. So, it's a robust market. It performs. It does. It ebbs and flows based on conditions, but overall it's performed well. So I think as a concluding comment, I think we can say that it's been a difficult period. It's been a capacity constrained period, but certainly it hasn't been a period that could be summed up as market failure. Good. I think we've had our time. So thank you very much. Thanks for the opportunity, and we look forward to chatting to you over the lunch break later on today.